Hello, namaskar, and welcome everyone to the third episode of this show on funding for entrepreneurs. We always want to keep it light and easy for the owners, the entrepreneurs themselves, the directors, the CFOs, the CEOs to understand in a very layman term all these topics of banking. We started with initial how the funding happens, what are the types of funding that are possible, how one can judge how much funding should one take, what are the basic processes and procedures to be adopted. In the second episode, we jumped on to the topic of debt versus equity and when one should start taking equity and when one should switch to debt and again switch to equity over a period of time. And it was very nice and insightful discussion. You can look at that video in the pin box above. We will now jump on to the third discussion with regards to when you are already a matured entrepreneur settled in the industry and having worked with few of the bankers over a period of your time and have reached at a certain place where you are looking to think through that whether this is something that is going fine. Do I need to look at a new relationship? Do I need to look at an alternate relationship? Do I need to look at a complementary relationship with a different banker so as to make sure that my enterprise is secured and I will get adequate breathing in the form of funding from that banker right at that time and at right cost and in right uh, um, process or time frame that is available with me to take the debt. That is when it helps me the most. So I would go back to Tejas and ask him this question that what is the right time for one to look at an alternate banker or a complementary banker?
So, yes, Mitesh, I think the question has been put up very rightly and in a very appropriate manner. So, I will start here with the true actual way of doing business is when a banker is actually considered as a partner in business. So, very rightly put by you, ki how can a banker support at various stages to an entrepreneur who is looking at growth from various angles. Now, if you consider a bank as a true partner, there are a lot of stages and all those things wherein you would obviously feel that is the current banker a right choice for me? Because the bankers have been there with you. You have supported the bankers have supported you with the right amount of support required at each and every stage of our business. So when you say a banker is always there with you when there are some urgent requirement of funds. You are there with the banker when a banker needs a sort of cash flow required for their FDs or for their current account balances, etc. So it's a very mutual relationship with the banker and the client enjoys all round the relationship towards the entire tenor. So yeah, to put these things in right perspective, when is exactly a time when you actually look at say replacing a banker? So when you said a new relationship, so now there are various stages in a relationship when you will have to look at those sort of parameters on when you are supposed to look at a new banker. So now generally when a simple answer comes is nothing but yeah, if I'm not getting a right rate of interest or if my commercials are not good or if my service levels are not good, I should look at a new banker. But let me put it very strongly here that changing a bank is not easy. So not only from the efforts perspective, but also from the cost perspective. Obviously, there is a lot of, I would say, money involved in the documentation and the stamp duty, which obviously goes to the government when you start or look at starting a new relationship. So this decision becomes very important for an entrepreneur to take a right decision because obviously a lot of efforts from the team as well as a lot of money goes when you are looking at starting a new relationship. But saying that, obviously, there are certain times when you would have to take this bold step of moving to a new relationship. But when? So, I'll put it in that perspective. There are normal courses where there is a requirement of additional capital, which can be obviously looked upon by your existing banker. But again giving here a perspective, if you are aware that RBI had actually put restrictions on a few PSUs and all banks based on their NPA ratios as well as their performance, and because of which a lot of clients had to suffer. So now, if you are in such a situation and with such a bank where your growth is getting hindered by the performance of the bank as well as the rating of the bank, that could be the first time which you can start thinking about moving from a existing bank to a new banker. With that comes obviously the other very clear objectives of getting better commercials, better service levels. Now, these are things which people do not generally have envisaged or have gone very deep into. There are a lot of products as well which a normal banker or which an existing banker does not come to the client, even if that products would have suited to your existing business. So I'll throw some light on this. Yes, commercials are very easy. As someone giving you a advantage or saving of 2% and all those things, it gives you a clear thought process of why should not I move to a banker which is giving me much better rate of service, the rates or the commercials. Services again, yeah, I think if your business is attuned to having more of branch banking, where your collections or your deposits are coming to the branch level, you'll need to look at a bank which has a very bigger and a good network of branches across. So this could be various reasons. But coming to the third point which I highlighted about the products, so, say for example, you are an exporter and you have a lot of revenues coming in dollars, a lot of foreign currency exchange involved. There are a lot of, other than lending, there are a lot of other services which a bank provide, like the remittances. So there are inward remittances, there are outward remittances. So there could be a few banks which could be very competitive in those sort of remittances. Again, I'm not defining here as a private sector bank or a public sector bank or an MNC bank. Each and every bank has its own strengths and weaknesses. Now, knowing that, and that is the main crux of the business, on which bank is good for which industry as well as which client. Now, that's again a jigsaw puzzle, because you would understand that if it's an exporter or an importer and there is a higher, I would say, complete inclusion of foreign exchange and all those things, then I would suggest that a MNC bank would be a right option, wherein they have a lot of products which are much competitive, which are much service oriented, and all those things in the case of foreign exchange. Now, similarly, coming to an example, if your business is attuned to where you need a lot of requirements of network branches, your collections come in the remote areas of different cities in India, you might need a network like HDFC or an ICICI which has been spread across with a lot of network of branches. So that product selection, according to me, becomes very important depending upon your business model and depending upon your product experience. Now, to add on to that, there are a lot of other areas related to, again, coming back to the business model. Now, if you are looking at a lot of products which are more conducive to your Indian sort of banking, when I say Indian sort of banking, is nothing but it is more of cash collections, more of CMS, more of cost which are related to, again, payments and collections related to transaction banking. Indian private sector bank would be a better option. So when I'm throwing these examples, the idea is nothing but depending upon your business model as well as your industry, the perfect bank could be the right choice based on the existing combination of the services that you're looking at. Now, coming again to the point on when should I look at moving. So obviously, as I gave you the first option where it's a no choice for a client, where the bank is not performing and the bank is currently hindered, so you actually will have to move on immediately. Other than that, there are various ways of obviously negotiating with your existing banker and trying to see whether whatever products that you are looking at is currently available at the existing bank or not. But for that, you first need to understand the business model of yours, what are the structured products that you can look at, and that is how you can negotiate with your existing banker. Now, okay, so this is one layer of banking when you are looking at, say, looking at a replacement of a banker. But when I'm talking about a true entrepreneur, the guy has very strong relationship with the existing banker. Everything is growing gungo about with the banker. Banker is very happy with the client, and client is obviously very happy with the banker. There is a stage wherein you will have to start looking at an additional banker. Now, I am saying that obviously once these relationships are so strong, no bank likes to leave any strong relationship or a good relationship. But from your perspective, you will have to say that you have to look from a future potential business, and that is your growth rate that you are growing at. Say for example, I'll just give you a very small example of a company, say turnover of around 250 300 odd crores, growing at almost 20-25% every year. So till a particular time, I would not put any sort of a benchmark number here, but the idea is nothing but when a 300 crore company, depending upon its working cycle, is enjoying say limits of around 30 odd crores with their existing working capital banker. Now, at that stage, obviously, when you are moving from 300, say 25% growth, you're moving to 375, 450 odd, etc. According to me, you should start looking at a new banker, because at each and every stage, even a banker will have their own limits at their end about taking a single party exposure on a client. Now, when I say 300 crore client with a 30 crore working capital, according to me, that is the right time when you can start looking at a new relationship, say with a small value of 10 to 15 crores, depending upon your requirement as well as the comfort that has been derived from the other banker. Now, the reason are again multifold. It's not that your bank is not serving you well, but depending upon again your business model, there could be a combination of a private sector bank and an MNC bank, where an MNC bank would be good in various products, various services, and various remittances and all those things which you are coming from different countries. The private sector bank would be good at your cash collections, at your transaction banking, and all those things. That's combination of two banks can serve well with you on all the products aspects and all those things. Because in the previous example I had said there will be someone who will be only looking at network of branches, and there would be someone who is looking at only exports. But if I'm talking about a big company of around say 400 crores, he will have both. He might have a lot of dealerships and all those things where he's actually selling in a lot of remote areas, but he would also require a lot of good import limits because he's importing it from various countries. So this sort of a combination might require a combination of banks which are strong at both the ends. So from that perspective, also once the other banker comes in, the existing banker gets slightly more cautious. And that is actually, if you ask me, as a banker, I have been a banker my whole life. I can assure you, obviously, a banker would be more cautious when there is another multiple banker coming in the relationship, because obviously everyone would want to have the bigger pie of business from a client. So that helps you to negotiate with your existing bankers on your commercials, on your services, on your products, as well as on your size of limits. Now, just to add, when I say size of limits, say for example, you are running your 30 crore of limits at a 70% collateral ratio. Now, there will be an aggressive banker who is ready because of your performance, because of your track record, and because of your credentials, that he is ready to lend you the new limits at 50% collateral. Now, this is where the advantage is. When there is a combination of two bankers, the existing banker, obviously, unless and until there is some red alarm in your company, is going to be ready to lend it at a much lower collateral as well. So bringing a new banker at the right stage can obviously help in a lot of ways by improving your efficiencies, improving your commercials, improving your service levels. And depending upon, again, there could be a lot of, when I say, just to again give you an example of an MNC bank, there could be a lot of products which are not given by an Indian bank for that matter. So when I say if you are using bias credit, which there was a stage at a non-availability of bias credit was a bigger challenge with an Indian private sector banks as compared to MNCs. So what if you were stuck in the same business when there was a private sector bank moving with you? So if you are at an opportunity where your size almost determines that there is an additional new banker, you should actually look at having multiple banking, which can help you with all those advantages. So I think Mitesh was also talking about what's a complementary banker. Now, when I say complementary banker, I would put it a slightly different connotation. Here is nothing but it could be a banker or it could be a financial institution. So, a lot of places, what happens is there are a lot of unsecured structured products which an NBFC can do in conjunction with a bank. Again, coming to an example where your collaterals are exhausted, where you've got the maximum limits that you can get based on your numbers, based on your financials, as well as your collateral ratios. Now there will be no other bank for that matter coming in as an unsecured lender with you. In those sort of cases, there are a lot of unstructured, when I say unsecured, structured products like invoice discounting products, like a lot of factoring products, which can come from an NBFC, which could add as an additional funding line in existing comfort from their existing banker, as well as an NBFC coming in with your additional collateral products. So I think that is what I can vouch for a complementary banker in this case, when the funding from an existing banker can be complemented by an NBFC which are giving structured unsecured products. So that is what I broadly define as the products that can be provided from an existing banker, from a new banker, as well as a additional banker.
Great. So, one more question that is coming in my mind
Right.
is lot of entrepreneurs today in tier 2, tier 3 cities, even in tier 1 cities, are still using cooperative banks as their
Right.
primary bankers and are dealing with them and are very, very, very comfortable with them in many cases.
True. True.
Uh, so what do you suggest for them? Should we suggest that they should continue as it is, or they should look out, or they should think in a different way in different situations?
So, rightly observed, Mitesh. Yes, you were very right in this observation, where you will find a lot of old companies, vintage companies, still continuing with their uh, bankers which they had started their relationship with, which could be various cooperative banks as well. So, nothing wrong with a cooperative bank, but the idea here is nothing but, I'll again boil down, because every decision making is according to your business model, according to your requirements, and according to your comfort levels. Generally, why do not people move from cooperative banks, etc.? Let's get into that discussion first, because I believe a lot of people have already sort of developed that sort of a comfort with the senior management of a particular bank, and they do not want to break that sort of a comfort or a relationship with the existing banker, which is never wrong. But it depends. Say, for example, nothing, not to name any cooperative bank here, but if there are certain products required by the client, say a simple example, there is an LC which is issued by a cooperative bank, which generally is not accepted by a lot of countries outside India because of their internal rating, because of their internal standards. So that is when a client obviously will face a problem of not able to do business with those sort of clients in those sort of countries. So that could be one way wherein the client could be restricted because of getting stuck currently with the existing banker. Also, it depends on the commercials. Now, what I understand from a lot of cooperative banks and there's a lot of other slightly low rated banks, their cost of commercials and everything is not very low. It is generally high, and that high is also not sustainable. It becomes high, very high, because what it all depends upon how you actually are performing in your banking structure. So what happens is nothing but, if you are aware, when there was a restriction from RBI on a lot of banks because of their NPA ratios and all those things, these were the banks which were actually were the most troubled, and because of which a lot of clients related to their banks were the most troubled. So people have actually learned a lesson from them, and there is a lot of awareness in the market. But yes, the people who still continue with their existing relationships and are able to perform business, get the limits, get the products, and all those things, nothing wrong in continuing with the same existing banker. But as and when you should actually start basically understanding on what are the products that are being offered by the competitive banks, that is when you will be able to compare with your existing banker, and that is when you will get an actually true picture of where we are actually moving. So that is what I can answer from a cooperative bank perspective, Vitesh.
Yeah, great. So I think to summarize, there is a lot of substance, first of all, to be with your existing banker and maintain nice relationships and also demand good service, good price, and good products from them. Uh, if this doesn't happen, and it doesn't happen when you outgrow your banker, when you become really big or matured, when the banker stops drawing comfort from your ambitions, or vice versa, when your ambitions stop drawing comfort from the banker, the challenges start happening. They may not be looking like relationship challenge or personal issues with an entrepreneur or a banker for that matter, but they may be an institutional issue or the issue of a company outgrowing a banker or a banker outgrowing a company. And that is when you look at a new relationship. You study the relationship, look at the cost of change. That is a big cost, stamp duty and all sorts of registrations of the documents. Everything is going to be costing you very dearly. So look at that and see vis-a-vis whether the benefits are adequate and are going to improve your overall buoyancy and growth rate because of the capital that you are going to get through these other sources, and then only jump into it. Second alternative is to look at complementary products by small NBFCs or even nowadays large NBFCs like Bajaj or Tata, really big NBFCs who offer a lot of competitive products. A lot of venture debts are also available in the form of complementary products, sometimes even completely non-collateralized products to fund your ambitions. That's also something that is to be looked at. But caution is the cost of these products and sometimes rigidity of prepayments and other issues that they bring on table because of course, they also need to maintain their interest and they also need to cover their risk. So it is always not one side of the table, but both sides of the table are important. And lastly, look at a banker who is going to run parallel with your existing banker. Start finding products which can be good for each of them. Start balancing both of them. It's like having two wives in one home, or you can say एक म्यान में दो तलवार. But that is how entrepreneurship happens, as we all know, and that's how the world practically runs. So nothing wrong in trying good products from each one of them, balancing each one of them, cautioning each one of them, and in that process, gaining your bargain or benefit from each one of them in whatever sense possible, and moving in a tandem with them. So these are certain ideas which we felt are relevant, and a lot of questions come from our clients regarding current bankers, relationships, cooperative banks, and stuff like that. And we always tend to advise them on the basis of a balanced view as to what is actually good for them, how it will help them. Use right people for advice. That is also an important angle that one needs to consider. With this, we would like to close today's discussion. We'd like to again request you to share this video with relevant people in your network who would be having similar questions. Also, like and subscribe our channel for further videos and debates and discussions with experts like Tejas on various topics of tax, audit, accounting, and consulting in various Indian and global scenarios. Thank you, everyone. Thank you, Tejas, for being on the show. And we close this video now. Thank you.
Thank you so much, Mitesh. It was wonderful having you. Thanks.
Yeah, thank you. Bye. Bye, everyone.